Now people, let's continue our revision discussion. Now we'll be revising buyback of securities. This equity shares with the differential rights was there previously. Now it's been removed from our syllabus, so leave that out. If it's there in your chart also, remove that, it's fine. Now, buyback of securities means what, sir? Buyback. Buyback andre buyback. Ashte. Sir, securities here refers to equity shares. Securities here refers to equity shares. So essentially you are buying back what? Equity shares. Buyback means cancellation. Instead of issuing the equity shares, now we are in the mood to cancel equity shares. So if at all equity shares gets cancelled, what are the things we need to do is what this standard, this topic is trying to explain. We don't have any standard essentially for all this. Okay, Saru? Okay, sir. Now suddenly look at the Josh. Last class, mein how Josh will come. Okay. So buyback simply means what, sir? Cancellation. Now people, for buyback, there are some provisions. Usually I don't see much of this being tested, at least in the new syllabus, but quickly we'll run through. Only fully paid up equity shares should be bought up. Can be bought back rather. If you have any calls and arrear shares and all, then such shares are not permitted for the buyback option. Then you can't cancel 100% of equity shares. Up to 10% of equity shares you can cancel with the help of board resolution. Up to 10%. If you want to cancel more than 10%, but up to 25%, you need to pass a special resolution, meaning 3/4 of the majority voters should agree to it. And another thing is, once the resolution is passed, you need to buy back within, or you need to complete the buyback within 12 months of that resolution. Once you buyback is processed, the shares must be physically destroyed within 7 days. So these are all some of the provisions, and obviously buyback should be authorized by the articles of association. No need to mug it up, just know it in case any MCQ gets picked up. Straightforward theory and all, doubtful, but you can never say never with ICI. There is always somewhere something coming in extra, so don't know when that will come. Next, people, it's a simple topic, or maybe one thing is that, sir, for buyback, there are some limits set. There are 3 limits. So you will test all the 3 limits and take the lower of the 3. Maximum buyback limits recommended over here. First, we call it as share test. Share outstanding test also you can call it. The first test, it's all 25% test. That means first test says that you can maximum cancel 25% of the number of equity shares existing. If you have 1 lakh equity shares, can you cancel entire 1 lakh or only 25% of it? Only 25% of it. That's what first test, that is share outstanding test, is trying to say. Second test we say is a resource test. What that says is 25% of paid up capital plus free reserve plus security premium. Calculate something called 25% of paid up capital, free reserve and security premium. That is a maximum value of buyback that you can do. This, if you do, you will get not the number of shares, you will get the value. Take that value and divide by the buyback price. Buyback price will be 30, 40, it will be given to you in the question. That way you will get the number of shares that can be bought back as per the resource test. We'll apply in question also, just saying. Third one is debt equity test or debt equity ratio test. What that particular test says is debt equity ratio post buyback. Debt equity ratio after buyback should not exceed 2. Debt equity ratio post buyback or after buyback should not exceed 2. Meaning, when you do debt divided by equity, maximum it can be is 2. Maximum it can be is 2. It cannot go beyond 2. 2.05 not acceptable. 2.10 not acceptable. Maximum acceptable is only 2 or lesser than 2. This is what third test is trying to say. Done, Ajay? Alright. Now what you have to do is you'll have to calculate all the 3 limits and take the highest of the 2, highest of the 3 or the lowest of the 3. Lowest of the 3 is the maximum permissible buyback. Suppose this, when you calculated, you got 25,000. First, when you calculated, you got 25,000. Second May, you got, let's say, 27,000. These are all number of shares, okay? Third May when you calculated, let's say you got 20,000 shares. Third May you got 20. How much maximum company can buy back? 20. But company wants to buy back only 15. Is it acceptable? Huh? Sir, this is the maximum limit. This is the maximum limit. You cannot cross this limit. If you want, you can do a lesser buyback. You cannot do a buyback higher than this limits is not permissible. Okay. So check that also once. Sometimes they will say, ICA has done this. Many students got that wrong. They asked maximum limit. And then this example, in a way like this example only. What is the maximum limit? 20,000. Then they said in the next para, company wants to buy back only 15,000 shares. Pass the journal entry. Or majority of the students pass the journal entry for 20,000. Go in there. Because company is buying back only how many shares? 15,000. All the entries are correct, but amount is wrong. Marks. That also once they have played around. So careful. This is the maximum limit. If they don't say anything, you will pass the journal entry for what number of shares? 20,000. But if they specifically tell how many shares are being bought back, pass the journal entry only for that. Okay, Ji? Okay, this is one. Next, people, whenever a company does buyback of equity shares, what happens to equity share capital? What happens to company ka equity share capital? It will reduce. Now, visualize this. Shareholders are owners of the company. Equity shareholders are owners of the company. When the company does buyback, what will happen? Shareholders will surrender the shares. Company will give money back to the shareholders. That means in a way, owners will get back their money. Right? Now people, in a company, let's say there are owners called shareholders. There is bank loan people, there are creditors and all. Who should get their money first? Debenture holders, creditors, those people should get their money first, or owners should get their money first? The outsiders should get their money first, yes or no? Outsiders like debentures, bank loan, creditors, etc. They should be repaid first. But here what is happening? Owners are getting their money back. Is it fair for the owners? Now, if is it fair for the owners? Yeah. But is it fair for the creditors and debenture holders? No. And company has limited liability. Now, if something goes wrong with the company, can directors go to shareholders' house and tell, from today onwards, I will stay here only? No, right? Because company has what liability? Limited liability. So, I mean, this in a way is unfair to whom? The outsiders. Because their liability is still not repaid, but owners are getting back their money. Hence, there was a concept introduced called CRR, Capital Redemption Reserve. CRR, Capital Redemption Reserve. CRR is basically created with an intention to protect the outsiders. CRR is created with an intention to protect the outsiders. How? Very simple. Sir, how do you create a reserve? General reserve, how do you create? From P&L only, you can utilize P&L and create general reserve. Yes, same way that also. CRR also is created from free reserves. CRR was also created from free reserve. Free reserve means any reserve which is available for dividend declaration, we call it as free reserve. Any reserve using which you can pay a dividend is known as free reserve. Usually that is general reserve and P&L. Usually. In all our problem, you will see instead of revenue, general reserve, sometimes they will say revenue reserve also in the question. One and the same. Okay, people. Now visualize this scenario. Now, people, before CRR creation, P&L balance was 50 lakh. Let's assume. Before CRR creation, P&L balance was how much? 50 lakh. Now, if company wants, they can declare a dividend to the extent of 50 lakh. Do you agree with me? P&L has a balance of 50 lakh means company can declare a dividend up to 50 lakh. Is my statement right? Yes. Now, when you create a CRR, what will happen to P&L balance? Reduce. P&L balance from 50 lakh, it will fall. Let's say you have to create CRR for 10 lakh assumption. How much also I'll tell you. Let's say you have to create a CRR for 10 lakh. So what will be the revised balance of P&L now? 40 lakh. After you create CRR, P&L balance will become 40 lakh. Now, how much dividend maximum company can pay? 40 lakh. How much money got blocked? How much money got blocked? 10 lakh. Why? That way, the outsider's interest is getting protected. This is one means to protect the outsiders. Is it okay, people? And CRR is created only from one and only one reserve, which is what? Not P&L, called free reserve. Free reserve means what? General reserve and P&L. Meaning of free reserve is any reserve from which you can pay dividend. Okay, sir. Entry for CRR, you tell me, let's see. What is the journal entry to create CRR? When you create CRR, let's say from P&L, what is the journal entry? P&L balance will reduce. So the entry will be P&L account debit to CRR. If you're creating for 10 lakh, you'll pass the journal entry for this. Okay. Sir, CRR will get utilized for what purpose, sir? CRR can be used for one and only one purpose, that is to give away bonus shares. Bonus shares means you already know. Additional shares given to existing shareholders at free of cost. So if you want to utilize CRR, you have to give away bonus shares. So if bonus shares are issued, the journal entry will be for bonus shares, you will utilize CRR. So when you utilize CRR, its balance will reduce. CRR has what balance? Any reserve for that matter has normally what balance? Credit balance. When you utilize, debit it. So the journal entry will be CRR account debit. Ideally, you should write equity share capital because bonus shares is also equity shares. But from the day they declare bonus shares till the day actually bonus shares are issued, there will be some time gap. Hence, we route it through two entries. First entry is CRR account debit to bonus to equity shareholders or shareholders account. Then bonus to shareholders account debit to equity share capital. If you add this account, this will get nullified. Effectively, the entry is what? CRR to equity share capital. If at all you want to utilize. Amount I've just taken for example's sake. Okay, sir. This is the whole thought process behind CRR. Now the next thing goes, sir, how much CRR we have to create? How much CRR to create? There are two ways to remember. One, how much our capital gap is there. How much our capital gap is there. That capital gap has to be filled up by creating CRR. That is one way. Or how much our free reserve you have utilized. To that extent, you have to create CRR. One of the two ways. Maybe I'll use capital gap. That's easy probably to correlate. Let's take this case. Sir, company wants to cancel or buy back equity shares worth how much? 3 lakh. Sir, or maybe I'll go one step back and then maybe take this. Sir, there are maybe three, you could say, methods of buyback, which I used to call it as profit shares combination in our regular class. Okay. Maybe I'll use the same terminology. Profits, shares, combination. What this is first case of buyback is company will buy back the shares. No new shares will be issued. What? No new shares will be issued. When we say new shares, here we're talking about preference shares. No preference shares issued. Company only, what did they do? They bought back. That is first method called profits. Shares means some equity shares are bought back. What shares, what new shares are issued? Preference shares. Rare, but it could be a possibility. Third is a combination. Combination means partly profits, partly new shares. Okay, so those are the three ways through which you can actually do a buyback. Standard uses, topic uses a slightly different name, but meaning is this. Now let's keep that in mind and build some cases around it. Sir, company wants to buy back how many equity shares? 3 lakh of assumed. First case mein, company is not issuing any new preference shares. Company is not issuing any new preference shares. So which method? This is which method? Profits method. We're going for profits method. Now, how, sir, when you buy back equity shares, what does the word buyback mean? Cancellation. How much equity shares is getting cancelled? 3 lakh. Company will show equity shares in their balance sheet or equity share capital? Equity share capital. How much capital is getting reduced? 3 lakh. How much capital is getting reduced? 3 lakh. Capital is getting reduced by 3 lakh means what is the gap in capital? Gap means reduction in capital. How much? 3 lakh. Can you ignore that gap or fill it up? How? Create CRR. Did any new capital come? Did any new capital come? No. That means how much is the gap still remaining? 3 lakh. How do you fill it up? That means in the first case, you will create CRR for how much value? 3 lakh. Got it, huh? and you will create CRR using free reserve. Next case, man. Let us say company wants to buy back how much equity share capital? 3 lakh. But company issued new preference shares worth 2 lakh. So that means company is doing two transactions here. Equity share capital they are cancelling. That means when you do this, what will happen to equity share capital? Reduced by 3 lakh. But they have also issued new preference shares. So what will happen to preference share capital? Increase by 2 lakh. Out of 3 lakh, see, equity share capital is also capital, preference share capital is also capital. Out of 3 lakh capital, how much gap is already filled up by preference share capital? Out of this 3 lakh gap, preference share capital has already filled up 2 lakh. How much gap still remaining? 1 lakh. That means in this case, can you keep the gap remaining or fill it up? How much gap will you fill it up? 1 lakh. How do you fill it up? That means here you will create CRR for. Usually you see this case. This also is a possibility. Okay, sir. Okay. Next, entries. Entries also, you know, you are experts at journal entries. Sir, you are buying back equity shares means you are cancelling equity share capital. Equity share capital has what balance? Credit balance. How do you cancel it? So first entry will pass as equity share capital debit. Okay. Now let's say you want to cancel equity share capital worth 1 lakh. Do you think shareholders will agree for buyback at face value or they may ask for premium? They may ask for something extra because it's a negotiation. No? See, if you want to cancel, suppose you are my company ka shareholders. I am the company, right? I am asking you surrender the shares. Face value is 10 rupees. You are telling 100. Look at her. Okay, let's take her point only. She's asking how much? 100. She's saying 100 rupees give macha, otherwise get lost macha. See the baat, no bakwas. Okay, and that's absolutely like, she's that. Now I have no power. I want to cancel the shares. I want to do the buyback. That means what will I do? Pay 100 rupees and cancel. Face value is only how much? 10. How much extra I'm paying? 90. For me, for the company, that extra 90 profit or loss? Loss. That we call it as premium on buyback. It will be given to you in the question. It could be given in percentage or it could be directly given, whatever. Right? For simplicity purpose, I have assumed the premium to be 20,000. Premium is a loss to be debit. 2, you'll have to pay someone. No? You can credit equity shareholders account, but our ICA material uses equity share buyback account. Because you have to pay this amount to whom? Equity share holders. But instead of equity shareholders, ICA is using equity share buyback. So let's probably stick to the same. Done. Now this premium on buyback is for a company, this premium on buyback is a loss. Loss usually goes to P&L. But hang on, we have 5 utilization of securities premium, if you remember company law. I think section 52 or 55. Security premium has 5 uses. One of the uses is if you have any premium on buyback, it can be set off first with securities premium. Instead of transferring this loss with P&L, first you can net off with SP. If you are netting off with securities premium, what is the journal entry? Securities premium account debit to premium on buyback. Suppose security premium has only 15,000 balance. How much is the premium on buyback? 20. SP has only 15 balance. Then balance 5,000, either you can use general reserve or P&L to premium on buyback. That's it. Okay, G. Third one, whenever you do a buyback, you have to create a CRR. What's the journal entry to create CRR? General reserve or P&L account debit to CRR. ICI material uses first general reserve, then they use P&L. In my opinion, you can use it any order, but ICI has a favoritism towards general reserve. First, they will use general reserve, then P&L for CRR creation. So, general reserve or P&L account debit to CRR. Here in this example, how much CRR will you create? How much capital did you cancel? 1 lakh. Did you issue new preference shares? No. How much gap is there in capital? 1 lakh. Can you keep the capital gap or fill it up? How? By creating CRR. Entry is general reserve or P&L account debit to CRR. Done. Last payment entry. What is the journal entry for payment made? Equity share buyback account debit to buy. Along with this, they may also say we have sold some investment. If there is any investment sold, pass the journal entry for that. Or if there is any fixed asset sold, pass entry for that. That extra may come. That's it. That's pretty much what they ask. This is one type of question which they ask. Okay. All right. I think this much theory is good enough. Well, quickly we'll take up one question. There are usually two types of questions that comes from this particular topic. One is the entry wala question. We will take up one question which has bonus also, so that we'll have end-to-end coverage there. And one more we have, I'll take you through. That is more often than asked, but first we will run through this question. Mukti Limited has the following information, some asset information they have given. All this they have given Goli. We don't have to worry about all this. The only thing I need to know again from here is what is the face value of each equity share. What is the face value of each equity share? 10 rupees. We have 1 lakh equity shares, each ka face value 10. That is good enough from the balance sheet. Rest everything is faltu information. Let's directly go into the notes or additional info. On 21st April, the company announced a buyback of how much? 15,000. Okay, ji. They have how many? They have how many? 1 lakh. They want to buy only 15. So looks like it is within the limit. No? So because we have 3 limits now, people. Share outstanding test, resource test, debt equity test. If they ask, then only calculate. Otherwise, not required. Okay. Here they've said company wants to buy back 15,000 shares at what price? 15. So the face value is 10, but they want to buy it back at 15 rupees. So is there any premium? Yeah, how much is the premium? The premium is buyback price is 15, face value is only 10. So the premium element is 5 rupees for 1 share. How many shares are you buying? 15. 15 5 is 75. No? So total premium on buyback is 75,000. Correct? Huh? For this purpose, they have sold all the investment at 2.5 lakh. Is it okay? As and when we read, we'll pass off entry also. Will you be okay with that? You sold all your investment for what value? 2,50,000. Now go back to balance sheet. What is the investment value? 2 lakh. How much did you sell it for? 2,50,000. What is the entry? Bank account debit 2,50,000 to investment 2 lakh to P&L 50,000. Or also you can pass bank account debit to investment 2.5 lakh, investment to P&L account 50,000, like the way we used to pass earlier. That is also acceptable. Okay, Naji. Correct, Naji. Next, on 25th April 2023, the company achieved the target of buyback. How much they wanted to buy back? 15,000. They were successful at that. All the shareholders surrendered their shares and buyback was a successful event. Okay. Buyback is now successful. Then on 1st May, company has come up with some bonus. Leave that. Buyback is done. Buyback usually comes with 4 entries. If you really want to remember yourself. One is share capital cancellation entry. Second one is premium setting off with securities premium. Third one for CRR creation. Fourth one for payment. Other than this, some investment sold and all may come, which we have already done. So can we root off those 4 entries? First, journal entry. Share capital always shown at face value. So cancellation also will happen at face value. How many shares cancelled? 15,000. Each ka face value 10. Entry will be equity share capital account 15,000 into 10, 1,50,000. But are you cancelling it at par or premium? Premium. Here they have directly adjusted it with securities premium. If you want, first you write. To be on the safer side, no, you always write premium on buyback first. Why? Because sometimes security premium will not have balance. See, this direct netting off will work provided security premium has balance. Here, check if you want. How much is the premium on buyback? 75. But how much SP we have? 3 lakh. In every case, SP may not have balance. So it is always safe to route it separately. I say, when you have enough balance, instead of writing premium on buyback, they directly knock it off with securities premium. If you are able to understand that adjustment clearly, you can do this. Otherwise, pass it individually, much better to avoid mistakes. Okay. How much is the premium on buyback? 75. To what? Credit will be given to equity share? Buyback. Okay. If at all we write premium on buyback, what will be our next entry? If at all here we write premium on buyback, our next entry will be security premium account debit to what? To premium on buyback. How much? 75,000, 75,000. This we will pass. Nanji. Then CRR creation. We read the question. Was there any new shares issued? Was there any new shares issued? No. How much capital did you cancel? 150. That means how much gap is there in capital? 150. Can you keep it or fill it up? Fill it up. How? By creating CRR. What will you use for CRR creation? General reserve, P&L. Do we have general reserve enough balance? We have 2.5. How much we need for CRR? 1.5. What entry? General reserve account debit to CRR 1.5. Last to payment entry. Equity share buyback account debit to bank account. These are the 4 entries that comes with buyback. Normal entries of 5 buyback is what I said. Done, sir. There is one more way, one more extra fitting or extra adjustment they can bring in, which we have seen normally also. What they will say is, you're supposed, how much balance is there in general reserve? Okay, 2. No, before this 2.5. Okay, what they will say in the same question is, you have to maintain a balance in general reserve of 2 lakh. You have to maintain a minimum balance in general reserve. How much? 2 lakh. I think I remember doing that somewhere. Here. Hey, so good only. Last batch I've done a lot of work. Okay. Suppose they mention maintain how much minimum balance in general reserve? 2 lakh. That they will say. Existing balance in general reserve, how much? 2,50,000. How much minimum you have to maintain? 2 lakh. Sir, currently available is 2,50,000. But at every point of time, how much you need to maintain? 2 lakh. That means how much can you utilize? How much can you utilize? 50,000. So in this case, can you utilize general reserve fully or only 50? Only 50. But how much you need for CRR? 150. So in this case, what you will do? 50 you will pick from general reserve. Balance 1 lakh you will pick from PI and then create CRR. This adjustment also gets tested a few times there. Another way. I think it is there. In study material also, I think these questions are there. Okay, na Sarji. And now the last entry for this problem, I think, is relating to bonus. Buyback is there, has done on 25th April. Few days later, that is on 1st May, company issued 1 fully paid up shares of 10 each by the way of bonus for every 8. What is the ratio? If you have 8 original shares, you will get 1 as bonus. Correct? Alright. Sir, how many shares are there? Don't take 1 lakh. Sir, before bonus on 25th April only, how many shares did you cancel? So you had 1 lakh shares. You already bought back how much? 15,000. That means the shares available is only 85,000. Yes, Saji. Because buyback has happened on 25th April. Bonus is coming later on 1st May. So the number of shares available is only 85,000. So what is the ratio of buyback? If you have 8 shares, you will get 1 as bonus. If you have 8, you will get 1 bonus. If you have 85,000 shares, then how many bonus shares can you give? 85,000 when you cross multiply, you will get 10,625 is the value or number of bonus shares. The number of bonus shares company wants to give. Any problem in the calculation? Sir, we'll pass the journal entry for number or value. What is the value of each bonus shares? So it will be 1,06,250. Okay, this is the value of bonus shares. For this, we need to pass the journal entry. First priority for bonus shares is whenever you are issuing bonus shares, first priority for CRR. Second priority is SP, securities premium. Last priority is for your free reserve. Okay, because CRR has only one purpose. Security premium has 5 purpose. Free reserve, there is no restriction. Hence, we use it in this order. Okay. Now, how much CRR have you created? 150. How much you need for bonus? So there is a shortage in CRR or we have sufficient? So that means should we have to touch free reserve and SP or only CRR is good enough? Only CRR is good enough. What is the entry? CRR account debit 1,06,250 to bonus to shareholders. Next entry is bonus to shareholders to equity share capital. At the back they're all okay? Okay. Sir, this is one kind of question that can be asked. Entries, and if at all they want, they can also ask you balance sheet also. Balance sheet is more like a residual topic in accounts. It can be attached to any topic. Okay, so that just be prepared that it can come with anything and everything. So that doesn't mean that every balance sheet you have to revise. Just to know the format by reviewing one or two, solving one or two balance sheets. Balance sheet simply review as calculator work. Don't waste your time by doing something which you are already comfortable. Okay, one or two questions you should solve it fully. Rest onwards, just keep it and keep ticking. Calculator work is good enough. That way you can cover more in less number of time. The intention is to cover all the types of questions. Not keep doing the same thing again and again. Nothing, sir. Okay, sir. Sir, one more type of question that can come is your maximum permissible limit wala question. You know, there was 3 limits. That is examiner's favorite actually. A lot of times that's been asked. So let's review. I think one time they asked it in MCQ format. Same. Normally they ask it in descriptive. Once they asked in MCQ. One and the same only. Whether they ask MCQ or they ask descriptive, we have to any which way solve. In MCQ we can do it a little bit as a rough work, but descriptive we have to be a little more legible. But anyway, concept and the manner of solving is pretty much same. So let's review this. Another type of question. Kesar Limited is a company. They've given too much golipa. Company plans to repurchase how much? 25,000 shares. Each ka face value how much? 10. But at what price? Buyback price is 20. Face value is 10. Do we have any premium? Yeah, how much premium? 10 rupees per share. Then chumma they've given all this blah 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 blah. No time. Leave. Share capital, all are fully paid up shares. One of the conditions for buyback is only fully paid up equity shares can be bought back, and it is fully paid up. Sir, they have not given equity shares. They have given equity share capital. How much? 1,50,000. Each ka face value is 10. So how many shares we have? 1,25,000. Here what we have to do is those 3 tests. No, they are asking a separate MCQ question. Those 3 limits, that's all. That's all they are asking. Same drama. So what is the first limit, sir? Maximum permissible buyback. First is the share outstanding test. What does the share outstanding test say? How much ever shares you have, 25% of that maximum you can buy back. How many shares we have? Don't take 12,50,000. 12,50,000 is the share capital. Divided by 10 if you do, you will get the number of shares is how much? 1,25,000. Of that you can buy back how much? 25%. How much is that? 31,000. So the answer to the first MCQ is B for Bengaluru. Solve, toughness, select. Over. Second is second limit. What is the second limit? Second test first of all is what? Known as resource test. What does the resource test say? 25% of paid up equity share capital plus free reserve plus securities premium. Take a calculator. Equity share capital how much? 12,50,000 plus free reserve. Free reserve means P&L. Add P&L 125. Revenue reserve is also free reserve. Add this. And then also add securities premium. Whatever I have box, add all of that. You're getting 31,25,000. So second, yes, no? 31,25,000. Second test says that only 25% of paid up share capital plus free reserve plus securities premium. When you add all this, you got 31,25,000. Of that, 25% comes how much, sir? 7,81,250. Now that 31 lakh, what you told, it is a number or the value? I mean, this is what? Maximum value of buyback. Maximum value of buyback. They ask maximum value of buyback or number of shares that can be bought. shares. And one share you are buying back at what price? 20. The maximum value of buyback is 781,250, and one share you are buying back at 20 means how many shares can you buy back? 39,062.5. Which option has that? D for Delhi. So Delhi is the right option. Calculate and select. Okay, G. The whole crux of this is the next test called debt equity test. This is a problematic area. Why? Tell me the provision once again. Tell me debt equity ratio for the provision. What does that buyback provision say? Debt equity ratio should not exceed 2. No, you swallowed one important word. Debt equity ratio post buyback, after buyback, should not exceed 2. Right? Now people, the provision says debt equity ratio after buyback should not exceed 2. We will be able to test that rule only when we know how many shares we are buying back. And now they are saying you only find how much you can buy back. Understanding the problem? Debt equity ratio is not before buyback, it is after buyback. How much are you buy back? Do you know, or that only we are calculating? That only we are calculating. But the rule is not based on before buyback, it is based on after buyback. And how much we are buying back, we don't know. Then how do I test the rule? Yes, understood. So now this one we'll have to solve a little bit on a mathematical side. Multiple ways to solve it. I followed the X method. I'll stick to the same. Okay. X method, correct. Finding your X, not your X. So here face, your X is gone much. Now we are talking about subject related things. Now we got the funda that the debt equity ratio condition is after buyback, but we don't know how much we are buying back. How to solve this problem? It's simple. First, what we do is, let's assume the total face value of the shares bought back be X. Not value. What have I assumed? Total face value of the equity shares bought back. I was assuming it to be X. I don't know, no? So I'm assuming it as what? X. Okay. Till now, if you don't like X, you can use Y also. You can use A also. Okay, X is okay, na? Fine. Alright, he says it gives a different feel. Okay, no problem. Done. So now test the condition. What is the condition? Debt divided by equity can be maximum how much? 2. Now substitute. Debt divided by equity maximum can be 2. So debt, do you already know? Yeah, check. Debt means your long term and short term debt. I think here only long term is given. How much is our long term debt, sir? We have two debts. So we have debentures worth 28,75,000. We have a loan worth 16,50,000. Add the two. Or maybe I've shown it separately only here. Debt is these two put together becomes your debt. Any problem, everybody? So numerator part is sorted. 42 lakh or 45 lakh, 25,000. Numerator is sorted. Divided by equity. Sir, equity, it's not equity share capital, it is equity. Equity here means equity share capital plus free reserve plus security premium. It is not equity share capital. Equity here refers to equity share capital plus free reserves plus securities premium. Okay, you already calculated that. If you want, once again, we will do this. First, write down what is equity share capital. 12,50,000. I've jotted. I'll tick one by one numbers. Okay, equity share capital is this plus free reserves. We have P&L worth how much? 125. Revenue reserve worth how much? 15 lakh. This is 1.25 lakh. This is 15 lakh. Okay, only this or even SP. How much is SP given in the question? 2.5 lakh. Okay, Naji. This is the number given in the question. But hang on. The rule is before buyback or after buyback? This is the number after buyback or before buyback? Equity share capital, security premium and all that is a number given in the question. That means all these numbers are what? Before buyback. But we want before buyback or after buyback? After buyback. Now we'll have to give buyback ka effect into this denominator. How to do it? Very simple. Sir, when you buy back, equity share capital will be same or it will reduce? Reduce. Share capital always shown at face value, and that face value only I assumed it to be X. Face value only I assumed it to be X. That means your equity share capital will be 12 lakh or it will reduce by X. It will reduce by X. This is one. Okay, see. Done now. Now people, the moment you buy back, there will be gap in capital. There will be gap in capital. Can you keep that capital gap or fill it up? How? By creating CRR. CRR you will create from what? Free reserve. You will create from free reserve. That means the moment you create CRR, free reserve balance will reduce. CRR is created to the extent of face value only. Because CRR is created to fill capital gap and capital is always shown at face value. And that face value only I assumed it to be X. Yes. That means the moment you create CRR, the general reserve or P&L also will reduce by how much? X. This is due to CRR creation. Yes, sir. Everybody good? Yes, sir. One more effect. What is that one more effect? Sir, did you buy back the shares at face value or at premium? Premium. How? Check here. Sir, face value of the share in this problem is how much? 10. Buyback price was how much? 20. That means what is the premium? Agreed. This data are you totally comfortable? I'm not telling this, given in the question. Check if you want. Face value of the share is 10. Buyback price is 20. That means premium on buyback is also 10. I want you to analyze these two numbers. Different or same? These two numbers. Different or same? And I have assumed the total face value only as X. If this is 10, this is also 10. So if this is X, this is also X. Simple mathematics. Yes, no? If here in this problem, face value and premium are different or same? Same. So if total face value is X, means the total premium also will be X. Agreed. Agreed. Sir, premium on buyback is a loss. Premium on buyback is a loss. Loss you adjust with. First you try to adjust with security premium. The moment you adjust premium on buyback with security premium balance will reduce. By how much? X. So 3x is not 1, no, 3. 3x. So you need to reduce. 1 for what? Look at the smile. They're not able to control only. They are only not able to believe. 3 nanta. Okay. Sir, 1x is for what? 1x reduction is for what? Share capital bought back. Share capital is reduced. Another X for CRR. Another X for loss. Premium on buyback adjusted with securities premium. Solve the equation and you will get X. That's it. Okay, that I've solved. Now you want me to solve all that? No, no. This you can manage. No. So when you solve, finally you get X to be 2,87,500. Simple cross multiplication will get you, will be able to solve the X. It comes to how much? 2,87,500. 287,500 is the number or the value. Brahaspati, now don't divide by 20, Guruve. I will start crying only. Don't divide by 20. Why? Because buyback price is how much? 20. Don't do. Why? Sir, what did I assume X to be? X is what? X is the total face value of the shares bought back. Here. Yes, no. Face value is 20, not 10 now. That means you will divide by 20 or 10. 2,87,500 is the total face value of the shares bought back. And the face value of the one shares is 10 rupees. So how many shares can you buy back? 28. Okay, Naji. So answer to this one is 28,750. 28,750 is there in C for Chennai. That's the answer. Okay, Saru. Now how much you will buy back? One test gave 31,250. Second test gave 39. Third test gave 28,750. What is the maximum permissible limit? Highest of the three or the lowest of the three? That is the next question. The lowest of the three is 28,750. That's all, Guru. Okay. Paka. You can sit and ask. It's okay. Little louder, ma. Sometimes no, my voice is not that. She is saying, what if premium is something? That is my next question, ma. We'll do one more, okay, na? Anything else? No. I cut her off question midway. You got her question now. Awesome. Even if you don't get, you'll get it in the next question. Okay. All of us are okay till here? Sir, I don't want to do all this, sir. Tell me one formula, sir. One formula is also there. But you will apply formula only for testing or if the question gets asked as an MCQ. Because, because whenever they ask you MCQ question, they won't check your working. They only check the answer. So use this formula only for MCQ purpose. What is that formula? Debt equity ratio should not exceed 2. That means express that in numerical denominator format. Debt divided by equity can maximum be what? 2. Yes. That means debt can be 2 times of equity, or equity can be half of debt. Do you agree with me? Do you agree with me? Whatever I've expressed here, equity can be equity required is minimum equity required is half of debt. Okay, take your calculator. How much debt we have currently? Adding these two, these are the debts. How much debt we have? 45,25,000. 2 debts we have, one debenture, one loan. Adding these two, you are getting 45,25,000. Easy. You don't have to solve anything. This one you will get it hardly in 10 seconds. The formula answer. 45,25,000 is the debt existing. That means how much minimum equity you require? Half of it. Do half of 45,25,000. 22,62,500. What is this? Minimum equity required. Minimum equity required. Currently, how much equity we have? Equity here refers to what? Equity here refers to equity share capital, free reserve, security premium. Take your calculator. We have already done, just for once more. Equity share capital 1250, security premium 250, P&L 125, revenue reserve 15 lakh. All this you add pa. This so. Add 31 lakh 25,000. So that means existing equity is 31 lakh 35,000. Yes, sir. We need, check the screen. Check the screen. We need how much? We need 22,62,500. How much we have? 31 lakh 25,000. That means we have more. We have more. How much equity we have more? What is the difference of these two? 8,62,500 we have more. Yes. Simply take this number. Okay, if you want it in formula, it is nothing but surplus divided by buyback price plus face value. Once more. If you want it in formula, surplus is this 8,62,500 divided by buyback price plus face value. This is a surplus. What is the buyback price? 20. What is the face value? 10. Do this. How much are you going to get? 28,750. Congratulations. What is the answer you got here? 28. You don't have to worry about all the exo pixo. Okay, straight away answer. But use this method only if they ask under MCQ format. That you can get the answer in calculator only. Hardly few seconds you will get. But in descriptive I suggest you still follow this only. Okay na? People, okay. Peace. I'll take photo. Done. He's actually taking. I was kidding. You take this one, macha. Don't take mine. I feel very shy. Over. No. What's your name, ma? Shreya. One question for Shreya now. Question number 5. Study material question. Her question was, in the last problem, face value and premium on buyback was same. What if it is not same? That case, no, what you will do? Question number 5, we will take care of that. 5. Can we try? This one you will do, Paka. Both X method and formula method. No, I want you to do both. Pratham Limited has some data given. Equity share. Each equity share ka face value how much? 10. What is share capital? 30 lakh. General reserve 32 lakh 50,000. Security premium 6 lakh. P&L 4 lakh 50. Revaluation reserve, is it a free reserve or not a free reserve? Not a free reserve. Consider this or ignore this. For buyback purpose, you can ignore. We only take free reserve and security premium, not others. Loan fund. Loan fund means debt. How much is debt? 42 lakhs. Okay. All you have to do is, you don't have to do all the 3 tests. You only have to do what test? Debt equity test you have to apply and tell what is the maximum number of shares that can be bought back when the buyback price is how much? 30. When the buyback price is 30. Face value is how much? I'll write the info, or I've written here. Huh? Probably no. Okay. Sir, buyback price, maybe this one I'll write. Buyback price is how much? 30. But what is the face value? 10. So what is the premium on buyback? Premium on buyback, can I say is 20? This is the data given. Okay, let's test it out. We are doing debt equity ratio, but debt equity ratio should be tested before buyback or after buyback? After buyback. So we'll have to, we don't know how much we are buying back. So what are we assuming? Let the face value of the, let the total face value of the shares bought back be X. Yes. Okay, let's maybe finish up few equations first and then come back. Debt equity ratio ka equation is debt divided by equity can be maximum what? 2. Okay, first let's update debt. How much is the debt? When you buy back, will debt get affected or no effect? No effect. So debt will still be how much? Debt will be still how much? 42 lakh. Divided by equity. Equity for this purpose is combination of 3 things. What are those? Equity share capital, free reserve, securities premium. Equity share capital how much? 30 lakhs. Plus general reserve will you add? Yes. 32 lakh 50,000 you add. Plus SP will you add? Yes. How much? 6 lakh. P&L will you add? Yes. 4 lakh 30,000. What are all this? What is this? Existing equity. Correct. Now this is existing equity. We want existing equity or after buyback equity? After buyback equity. Now we have to give buyback ka effects one by one. We are assuming what? Let the total face value of the share bought back be X. The moment you buy back, share capital will be 30 lakh or it will reduce. Share capital always shown at face value. It will also reduce by face value. How much is that face value of assume? X. Correct. Huh? That is one. The moment capital reduces, there will be a capital gap. Can we keep it or fill it up? Fill it up. How? By creating CRR. CRR you will create from free reserve, right? So that means general reserve or P&L balance will reduce. And since CRR is created to fill capital gap and capital is always shown at face value, CRR also you will create for what? X. Done. Now one more effect is what? Premium on buyback. Look at this data. Let's come back to this. What is the buyback price? 30. What is the face value? 10. So what is the premium on buyback? 20. Now I have assumed the total face value of the shares to be X. Now compare these two numbers. Are they same? Are these two numbers same? This is 10, this is 20. That means what? Can you establish a relationship? This is 10, this is 20. That means premium is twice the face value. You do 10 into 2. You do 10 into 2. How much is that? 20. So what is the relationship between these two? What is the relationship between these two? Premium is 2 times of face value. Agreed? Premium is 2 times the face value. If face value we are assuming as X means premium will be 2 times of that, which is 2X. Got it? Huh? Others also okay, right? So premium is a loss. Premium is a loss. Loss will increase or reduce? Reduce what? Securities premium. So because of this, security premium will reduce by 2X. Solve the equation. You will get X. You will get X. Now X is the number or the value? Value. But will you divide this by buyback price or face value? What is the face value? 10. So when you do that, you will get 129,500. This is your X method. Then you solve. Or you can use formula method. What is that formula? This is okay for everybody. Now what is the formula method? First you will take what? Total debt. What is the existing debt? The existing debt is 42 lakh. Then you will compute some. This is not writing only, no? pen also needs a break, I think. Total debt is 42 lakh. Next, we will calculate the minimum what? Required equity. Required. How much is the minimum required equity? Debt ka half, which will be 21 lakh. This is what equity we need. We need. But how much we have? What is existing equity? Existing equity is summation of all this. Equity share capital plus free reserve plus security premium. This is given in the balance sheet. When you add, how much are you getting? Numbers are proper, huh? 72 lakh 80,000. Sir, we need only 21. We need only 21 lakh, but we have how much? 72 lakh. That means, do we have extra? And that extra only we call it as surplus. Surplus is nothing but C minus B. How much is that? These two come minus 51 lakh 80,000. Now formula. There's nothing but surplus. If you want number of shares, you will take surplus divided by buyback price. How much is buyback price? 30 plus face value. So divided by 40. 51 lakh 80,000 divided by 40. You do how much? 1 lakh 20? 1 lakh 29,500. How much did we get when we solved? Say. Okay. You can use this, I feel, for when they asked it as MCQ, because you will get the answer hardly in few seconds. So much preferred. So now I hope this also is sorted. This is only for debt equity. In this problem, they only ask for debt equity. Okay. If they ask calculate the maximum permissible buyback, you have to calculate all the three limits. Take the lower of the three. Yes, people. That's it. Thank you.